Welcome to This Explainer. Today, we're diving into Howard Marks' latest memo to answer a massive question. Is today's stock market suffering from a dangerous psychological condition? Namely, a financial bubble. Now, Marks is a legendary investor, and exactly 25 years after he absolutely nailed the dot-com crash, he is officially back on bubble watch. Let's get right into it. So let's introduce our patient, today's stock market. And right off the bat, we're looking at a pretty staggering imbalance. Just 7 tech companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, you know them as the Magnificent Seven, they now make up a whopping 33% of the entire S&P 500. Think about that. That's a third of the market, and it's roughly double their share from just 5 years ago. To put that into perspective, during the absolute peak of the tech bubble in 2000, the top 7 stocks only captured about 22% of the market. So yeah, we are dealing with an incredibly top-heavy market right now. With things so concentrated at the top, how do we objectively figure out if this is actually a bubble waiting to burst or just, the new normal? That brings us to Section 1, Diagnosing a Bubble, State of Mind. According to Marks, you really shouldn't just stare at spreadsheets and math to diagnose a bubble. You actually have to look for psychological symptoms. A bubble is honestly more of a state of mind than a hard calculation. The clinical symptoms? You've got highly irrational exuberance, an outright adoration of these companies where people think they literally can't miss, and massive FOMO, the fear of missing out. But the absolute most crucial symptom is that last one, this terrifying conviction that there is simply no price too high to pay for these stocks. When people can't imagine a single flaw and are just terrified of being left behind, rational pricing, it completely goes out the window. There's this brilliant quote from Charles Kindleberger and Robert Alibur that perfectly captures the human side of all this. It goes, "There is nothing so disturbing to one's well-being and judgment as to see a friend get rich." It's so true, right? It's all about envy and this intense social pressure. Marks points out that market legends like JP Morgan knew things were going off the rails when his shoeshine boy started giving him stock tips. Or think back to more recent times, when you're in a cab and everyday folks start bragging about the 3 condos they just bought. It's that widespread participation by non-financial people, driven entirely by envy. This kind of mania develops pretty predictably through what Marks calls the 3 stages of a bull market. So in stage 1, which usually happens right after a market crash, only a few unusually insightful people can even imagine things improving. Then we hit stage 2. The economy is recovering, markets are up, and most people finally accept that, okay, improvement is happening. But stage 3, that's where the danger really lies. After a long stretch of great news and soaring stock prices, everyone suddenly concludes that things will just get better forever. At that point, investors completely lose all objectivity. They're basically viewing the world through incredibly skewed rose-colored glasses. But what actually triggers this sudden loss of rational thinking in the first place? Let's take a look at Section 2. The trap of the new. This time is different. The culprit almost every single time is newness. Whenever some unprecedented innovation comes along, investors convince themselves that all the rules of history just don't apply anymore. We've seen this exact pattern repeat for centuries. I mean, from the crazy demand for exotic Dutch tulips in the 1630s, to the South Sea trading monopoly in 1720, all the way to the nifty 50 stocks of the 1960s and the internet boom of the late 90s. When something is entirely new, there's no historical anchor to hold back the enthusiasm. Investors talk themselves into believing, hey, this time is different, and they adopt what Marks calls a lottery ticket mentality. And that leads straight into the emperor's new clothes effect. Marks makes this really astute observation. Investors would much rather go along with a shared delusion that happens to be making them incredibly wealthy, rather than call it out and risk looking foolish. Think about it. When the whole market is rocketing upwards and some specious, questionable idea is making everybody rich, very few people are brave enough to step out of the crowd and throw a wet blanket on the party. So, what happens historically when that party inevitably comes to an end? That brings us to Section 3, the price of perfection, buying well. Howard Marks actually learned his greatest lesson right at the beginning of his career, back in 1969, while dealing with those nifty 50 stocks we mentioned earlier. He realized there is a massive, massive difference between simply buying good things and buying things well. Buying good things just means you're focusing on the fundamental quality of a company. But buying things well, that focuses on the price you actually pay for that quality. It became his guiding principle for the next 50 years. Good investing isn't just about finding good things to buy. It's absolutely about buying them at a sensible price. To see exactly why that distinction is so crucial, just consider this number: 90%. Back in the late 60s, everyone was buying into those nifty 50 stocks. And to be fair, these were unequivocally the greatest, fastest growing companies in America at the time. People thought they were so good that nothing bad could ever happen to them. But because investors paid absurdly high prices, we're talking 60 to 90 times earnings, when reality finally set in, the people who held on to those stocks tenaciously ended up losing over 90% of their money. The companies were undeniably great, but the prices paid for them? Total disaster. Now, you might be thinking, well, today's tech giants are totally immune because they're just so dominant. But consider the top 20 S&P 500 companies from the year 2000 compared to the start of 2024. Only 6 of those 20 companies were still on the list 24 years later. The disruptors inevitably get disrupted. It might be by sharper competitors or just newer technologies. And what's even more mind-blowing is that only one single company from today's Magnificent Seven, Microsoft, was actually in that top 20 back in 2000. History proves time and time again that staying at the very top forever is incredibly rare. So, taking all this history and psychology into account, we arrive at Section 4, the verdict on today. Is it a bubble? What exactly is the prognosis for our current market, heavily driven by AI and these massive tech giants? A really key metric we need to look at right now is the forward price to earnings ratio. For the S&P 500, it recently hit 22. And what's super interesting here is the historical context behind that number. According to data from JP Morgan, looking at over 300 monthly observations across the last 27 years, a PE of 22 sits firmly in the top 10%. It is historically very, very high. And remember Mark's golden rule: the price you pay today dictates your future returns. So the million-dollar question is, what happens next? Well, historically, investors who bought into the market at that high multiple of 22 have seen their 10-year annualized returns stuck in a very narrow, frankly disappointing band, hovering somewhere between a barely positive 2% and a slightly negative 2%. Basically, when you buy in at the absolute top decile of historical valuations, precedent tells us your long-term returns are likely to be extremely muted or even negative if those multiples eventually compress and come back down to earth. However, Marx emphasizes that we have to remain completely objective here. We're not just running around yelling that the sky is falling, we have to weigh the evidence. On one hand, there are obvious cautionary signs. Valuations are undeniably above average, the AI optimism is absolutely rampant, and people are definitely assuming these top companies will succeed permanently. But on the other hand, there are very valid counterarguments. Yes, valuations are high, but a PE of 22 is certainly not the insane 60 to 90 times earnings we saw with the Nifty 50. Plus, the Magnificent Seven genuinely do possess massive scale, real technological advantages, and incredibly high profit margins. And crucially, Marx notes he isn't quite hearing that irrational "there's no price too high" mantra being shouted by everyday people on the street just yet. Which brings us to the ultimate question. And I want to leave you with this final thought to really ponder based on everything we've unpacked in this explainer today. Are we quietly slipping into another psychological mania fueled by the excitement of AI and this unprecedented market concentration? Or, given the unique scale and sheer dominance of today's tech leaders, is this time actually truly different? It is a fascinating tug of war between psychology and valuation. I highly recommend taking these insights and applying them to how you view the market around you. Thank you so much for joining me on this explainer, and as always, keep questioning what you see out there.